Welcome to BT Meet Me. Please enter your passcode followed by the hash key. Please record your name, followed by hash.
Predictor from AXA.
Thank you.
By the
Now joining.
Predictor from AXA.
troubled banking division is one such position that did well for us. We also had a position on Bank of Ireland, lower tier 2, where we had done significant work, and we highlighted time and again that the bank's capitalization and the bank's loan portfolio can withstand severe tests, and the bank will be able to return to the capital markets once it's been recapitalized. The recent Irish stress test to a degree showed that, and that was also one of the main plays for us during the quarter, which did well for us. Both these positions did not deliver as much return since the stress tests were only announced at the last day of the quarter, but they will play an important role in our performance in April. The other thing that worked for us were the floating rate note bonds in our portfolio. As some of you will know, we have a sizable allocation to floaters in the portfolio, since we think that at the moment investors are being offered a very compelling trade. Most investors have remained away from floaters simply because of the low yield, but we see this as a short-sighted decision. We think long-term some of these floaters, which are trading at a 40 to 50% discount and issued by institutions that were seen as beacons of safe haven during the credit crisis, are very compelling, both from a risk-reward perspective and also from potential alpha perspective. So those floaters were starting to get some momentum in the first quarter, and helped our performance in the first quarter, but we continue to see significant upside there. Third on the list of what worked for us during the quarter is the COCOs, or otherwise known as exchange convertible notes. It is very common these days to just refer to COCOs as one instrument. We take a slightly different view here. We see this as an asset class which has a spectrum of different instruments with different characteristics, with different risk-reward potential. And I would not want to go into too much detail here, but just to give you a top-level example, there are contingent capital notes that are going to be going concern, and there are contingent capital notes that are going to be gone concern. The going concern ones may be triggered while the bank is still solvent and still functioning, and therefore have a higher risk profile than those which are gone concern, which may never be triggered. And we benefited from one such instrument in Lloyd's, where the COCO bonds are simply never going to be triggered, simply because the trigger is set at 5% of core tier 1, whereas the Basel III requirement for the core tier 1 for this institution will be 6%. And that did well during the quarter, and we continue to see upside there. The fourth and final element that I would highlight here is our regulatory plays. These are playing on the Basel III and the Solvency II themes. As we've highlighted on numerous occasions, there is a significant potential for upside on a number of instruments and securities, not just in Europe, but across Asia and the US, that will be impacted by the rollout of Basel III and Solvency II. And the devil is in the detail here. You need to do your homework on the finer details of the prospectus, of the covenant of the instrument, of which entity within the group it's issued from, on the back-end spread, and we feel that we are on top of our game here, and we think we will continue to make good calls here. So we do expect to play or obtain a significant amount of alpha over the next few quarters from this space. Then we come on to I think it's only fair to talk about where we lost money during the quarter and where we could have done well. During this particular quarter, our fact-tail hedges and our warrant hedge, which was an option on Spanish sovereign, and was set in place to offset against the risk in the portfolio, the Irish risk that we had taken, both of these lost money. Now, although we lost money on both these instruments, or on our factor hedges and warrants, they played a vital role in the overall portfolio construction. And a simple example would be when the Japanese tsunami happened and when the nuclear crisis led to steep declines in risk assets, we were not in a panic situation simply because these factor hedges were able to deliver a massive P&L which kept the portfolio in the positive territory. And as a result, we were able to go out and look for alpha opportunities at a time when most people were focused on headline news. And a principal example would be the fact that we looked at substitute for nuclear space, taking the view that we don't believe nuclear industry is going to come to an abrupt halt, but yes, there might be some capacity taken offline, which leads to further price uptick pressure on fossil fuels. So we looked at one or two coal producing plays in Asia. We looked at one company which is significant market dominance in Far East Asia. This company has good vertical integration, has got good long-term customer contracts, and has price flexibility and pricing power. So we picked up their bonds. We also looked at a shipping group, which is one of the most dominant shipping group in the world, has a significant stake from a AAA rated sovereign, and its bonds had taken a significant tumble just in the aftermath of the nuclear crisis because some people misinterpreted the situation as impacting trade. So we took advantage of that situation and bought those bonds. So in a sense, the warrants and the factor hedges served their purpose. They allowed us to be out on the hunt looking for opportunities when everyone else was looking at covering the losses. However, we strive to improve ourselves, so one could say that we perhaps could have better timing on some selective profit taking on our hedges, and to a degree we did that, and we'll continue to improve that. So on the whole, we are fairly satisfied with the performance of our insurance hedges. I think after that review, it'll be useful to just highlight some of the challenges that we think we and the markets will face in the next quarter, and we turn to page 4 for that. Here we highlight the potential pitfalls ahead, and the one which is getting a lot of coverage both in the newspapers and from a lot of analysts is the increasing inflationary pressures, mainly in the EM world, but now we're starting to see increasing evidence of that in the developed world as well. And we think especially as a credit strategy, you need to take this seriously, and for us, we've partially offset this risk through a higher allocation to floaters, and also in many instances, some of the securities we have tend to be idiosyncratic in nature, and are not expected to be as sensitive to duration and interest risk. Nevertheless, it's something which we are mindful of and we're keeping an eye on, and if there was, as a consequence of this, some opportunities, we will look to play in that. The other thing which we think is a major pitfall ahead is the European banking stress test. We think the Irish stress tests were a model of transparency, a model of genuine, severe stress tests being implemented. You had BlackRock going through every loan on a loan-by-loan basis. You had Barclays Bank then being consulted for looking at the mark-to-market of the loans. You had Boston Consulting Group giving their input on whether these loans could be sold into the market. You had subcontracted accountants being brought on board. You had a delegation from the IMF looking through the loan books. You had a delegation from the European Commission looking from the loan books. And then you had a stress-tested core tier 1 of 6% applied, following what we would call has been one of the most transparent exercises in banking over the past 30 years. The Irish exercise of setting up the NAMA and transferring loans to NAMA and then offloading them into the market is the reason why the sovereign got into trouble, because losses were realized upfront. Banks tend to try and leak out their losses over a multiple year period. So they had already taken a significant hit on their balance sheet, and for that reason their capital had come under pressure. This particular exercise has gone even further. So the exercise modeled a 50% stress test, i.e. 50% decline in housing market. Then there was an additional buffer placed by BlackRock, then an additional buffer placed by the government. So you're looking at scenarios which which I would say that even the most pessimistic commentators in Ireland have said may not emerge. And then you had calculated a stress test core tier 1 of 6%. Whereas in Europe, we are now being told the stress test core tier 1 will be 5%, so will be 1% lower. We have not previously seen any transparency on the balance sheet of a number of these banking institutions. And what is more, the very definition of core tier 1 is still under discussion. For example, the Landesbanken sector in Germany would include in its core tier 1 instruments which would not be included as tier 1 in a number of other jurisdictions. So we think there is a genuine possibility for disappointment on the outcome of the European stress test, and that could lead to some turbulence, which perversely could play to Ireland's advantage, as folks will then turn to those institutions where they have more transparency. The next on the list here is quantitative easing, which has been the single biggest aspect of of any investor's consideration over the past 18 months. We had an advisory board discussion over the past few weeks where we discussed that it's much easier for us as analysts and investors to discount cash flow and liquidity flow at company level. But as investors, it becomes very difficult to take into account liquidity flows at macro level. And more often than not, we as investors get it wrong. And we think that the consensus view at the moment that everyone knows that quantitative easing will finish as of end June, and therefore it's already priced in the market, we think might be a bit too complacent. We think there is a meaningful probability of significant turbulence as we approach June. And for that reason, we think some caution is warranted, and a number of assets and asset classes out there might look rich, because hindsight is a great gift. When the quantitative easing started, not many folks would have said, oh, this will lead to appreciation of commodities in the fashion that it did. It's very easy to now look back in retrospect and say, yes, commodities benefited from quantitative easing, and therefore we've seen these high prices in commodities. But I think it's difficult for us to see what the impact might be as liquidity flows are taken back and which asset classes will be hit more than others. So for that reason, we continue to be vigilant, and we continue to look for those pockets where we think investors could take a hit. Fourth on the list here is consumer sentiment. We alluded to this in our annual outlook, where we highlighted how investor sentiment is outpacing consumer sentiment. And we continue to believe that that remains the case. If anything, the recent increase in energy costs, be it due to inflationary pressures, be it due to geopolitical tensions and uprising in Arabia and Middle East, are starting to bite consumer sentiment. Whereas in Europe and the UK, you've got the austerity drive impacting consumer sentiment. In the US, the energy prices play a much bigger role, and you have started to see the US consumer sentiment dip a bit over the last few weeks, which we think needs to be borne in mind. And that obviously ties into the next point on our challenges, which is the geopolitical risk and ongoing rising in Arabia. The big piece of the puzzle here remains Saudi Arabia, where the government largesse might have placated the population over the next quarter or two, but we don't think the risk has gone away, and we think that the status quo has permanently shifted, and it is something that investors need to consider as part of their portfolio construction, and we certainly will be taking this into account. So now that we've considered the potential challenges or some of the summary challenges that we expect in the next quarter, if you turn to page 5, we highlight some of the themes that we expect to play in the next quarter or two. The first point is alternatives to nuclear power, something which we've been implementing since the nuclear crisis happened, and we think that is a theme which will yield to potential alpha opportunities over the next quarter or two. The second point is agri-inflation, and I had